Hello, and you're welcome to Global Business Insights, where you get details behind the leading business headlines and key data releases. Crude oil resumed its rise this morning as we heard Israel attacked Iran. Spot gold also hit record high with explosions yet unconfirmed in the central province of Isfahan. Flights have been suspended over several cities. Isfahan is home to nuclear sites and a military air base. The scale and targets are still unclear. The strike came only after hours after Iran's foreign minister said if Israel took military action against Iran, Iran's response would be immediate and at a maximum level. And as the US vetoes Palestinian bid for full membership at the UN. Iran said it saw no missiles but had shot down several drones with minimal damage. Asian markets became a sea of red as the news broke this morning. US futures also sank. A raft of sanctions against Iran on top of the hundreds others was not a surprise as the UK and the US slammed tough measures and urged G7 and other allies to do the same. And still on Israel-related issues, we saw 28 employees of Google sacked yesterday for protesting against an Israeli cloud contract. We'll discuss that as well. Earlier, we got Japan March inflation numbers coming in at 2.7%, down from the 2.8% seen in February. The core inflation rate, which strips out fresh food prices, stood at 2.6%, in line with expectations. The Bank of Japan raised its key short-term interest rates for the first time since 2007, when it met last, to around 0%, to 0.1% from minus 0.1% in March 2024. And that was what markets had expected, ending 8 years of negative interest rates. India kicks off the world's largest elections today, where polls suggest that the incumbent Prime Minister Modi's party will score another landslide victory. Indeed, it was quite an eventful week with the IMF World Bank spring meetings, Iran-Israel standoff, hawkish comments coming from senior Fed officials, and the earnings season also kicking off. It's no surprise that sentiment has been at best cautious as the key US indices were all down for yet another week, and the S&P 500 saw its longest stretch of losses since October last year. There is still hope that the technology companies just beginning to report may still save the day. Netflix beats financial targets convincingly, but sprung a surprise in saying it will no more publish subscriber data that analysts are used to having as a means of gauging growth. And in Nigeria, a new regulation to criminalize damage of vital fiber cables following repeated complaints by MTN and other telecom communication companies is being rushed out in an executive order to be signed by the president. But Nigeria has never been short of laws. Bitcoin mining stocks were up yesterday ahead of the imminent Bitcoin halving event expected to take place in the next few days. The Bitcoin protocol ensures limited supply by periodically reducing the number of new coins earned by miners in a process called halving. It is generally assumed the next Bitcoin halving will take place on around April 20, 2024. US markets are still searching for a catalyst to sustain the upbeat mood that lingered through the first quarter, but so far Q2 seems under siege. First, the rate cut hype was dealt blow after blow as inflation looked stickier than expected, and Fed officials revved up a cautious narrative. Now markets are pricing one or two rate cuts, and a rate hike can't be ruled out completely. The AI hype was not spared. Even at some stage, the AI leader Nvidia was flirting with correction, suggesting the AI boost is vulnerable, just like other stocks could be. The earnings season so far has been mixed. The hard-to-please market was not impressed with the major US banks, even though investment banking and trading income streams were strong. And then we thought we had seen it all. Iran launched a brazen attack on Israel, which was followed by a calm. And this morning we heard Israel has retaliated, dousing market sentiment further. Indeed, hopes of a first rate cut in June may have been completely dashed. Bond yields have moved higher, and fears of an escalation to Middle East tensions have mounted. The market could definitely use some help from technology firms as they report to inject some fresh momentum into sentiment. So the stronger US economic data and latest upward revision of US GDP growth by the IMF should indeed reflect in better corporate profits. The US airline sector had signaled strong demand for travel, most notably among corporate flyers. United Airlines upwardly revised its earnings outlook, pushing its stock up and lifting the sector. But unlike the airline sector, which was in the valley, tech companies are already riding high, and expectations have to be much higher to justify their hefty price earning multiple. We just got Netflix yesterday after the closing bell, but next week things will begin to be much clearer with Microsoft, Alphabet, and Meta platforms all reporting. Will the tech stock inspire a fresh rebound in sentiment? We have to wait and see. At close yesterday, it was mixed on Wall Street. S&P 500 posted a fifth day of losses, down 0.22%. The Dow was flat, up 0.06%, while the Nasdaq dropped 0.52%. Netflix has in recent times focused on driving profit by raising prices, cracking down on password sharing, and growing its ad tier service. And that seems to have paid off as it unveiled its results yesterday. Netflix posted better than expected earnings, revenue, and subscriber growth for the March end quarter. But it also said it will stop posting its quarterly membership data and average revenue generated per member, saying that now that there are different cadres of membership, the information was not as useful. Netflix has been standing out amongst the other streaming players who are struggling to be profitable. Remember last year, its paid membership grew and it saw a 12% bump in revenue. This year seems to be starting on a similar note. Net new subscribers in the quarter was 9.33 million, almost double 5.1 million expected. Revenue was $9.37 billion, beating $9.24 billion forecasted. Earnings were $5.28 a share, also above guidance of $4.49. Netflix sees a Q2 revenue of $9.49 billion, which is close to $9.52 billion that the market was expecting. But they also warned that subscriber growth will be down in the next quarters due to seasonal factors. Stock of Netflix was down 2.4% in after-hours trading following the report. Netflix has built exceptionally well on its core streaming offering, finding synergy in partnerships in the live viewing, entertainment, sports, and other segments with higher growth and a strong menu of original programs and international offerings, moving aggressively outside the US into Asia and Africa. Its crackdown on people using someone else's account also paid off, as well as the cheaper ad-supported tier of subscription. Its ad tier was so popular, Netflix says about 40% of viewers elected to be on this cheaper service, and we understand Disney and other players are said to be planning to copy a similar move. The value proposition is simple: bringing the best entertainment to you anywhere you are and whenever you want it, with a very broad variety of offerings. Netflix sells convenience, wider choice across cultures and nations, and quality. It's an unbeatable, rich mix. Huge cost barriers and are there to be able to emulate what Netflix is doing, and no surprises, it just seems to be growing and growing. Just a minor snag. Agreed, indeed, entertainment has moved from the days of Sound of Music, when the hero always married the heroine and all lived happily ever after. The number one film today on Netflix, What Jennifer Did, is about how this young girl faked her degree, student loan letters, and hired murderers to come in her home and kill her parents. Jennifer Pan's shocking criminal case that took place nearly a decade ago has been thrown back into the spotlight in the form of a Netflix documentary. It went straight to the top of the table in terms of films people are watching, feeding a new disturbing demand for gory crime thrillers. And as we continue to monitor news of retaliatory missile strikes, the UK and the US have rolled out fresh sanctions against Iran. According to a White House statement, the US sanctions target leaders and entities connected to the Islamic Revolutionary Guard Corps, Iran's defense ministry, and the Iranians' government's missile and drone program, and those enabling this war. The UK Foreign Office imposed a travel ban and asset freeze on 7 individuals and 6 entities, including those involved in drone and missile programs. It's unclear whether sanctions work if, for example, they have deterred Russia from its aggression against Ukraine. It tends to further deepen difference and helps to justify the narrative of mutual hatred that makes these wars go on for longer. Longer wars can be very costly for innocent businesses and citizens. Rating agency S&P Global just downgraded credit ratings for Israel, citing escalating geopolitical tensions in the Middle East as a result of the country's war against Hamas in Gaza. Yesterday, Google said it had terminated 28 employees protesting an Israeli cloud contract, Project Nimbus. And that is the $1.2 billion contract awarded to Google and Amazon in 2021. It supplies the Israeli government with cloud services and supports the development of military tools for the Israeli government. In 2018, workers successfully pushed Google to shelve a contract with the US military. That was Project Maven, and that project was then meant to analyze aerial drone imagery with potential application in warfare. In the new high-tech warfare, missiles and drones are empowered with high-tech tools. The warriors of tomorrow's battles will be engineers, mathematicians, and scientists, analyzing and delivering the most strategic military intelligence capabilities in high-tech laboratories. Some have argued that wars will not stop, but could be less brutal if the means to fight it cease to exist. Tomorrow's battles are heavily infused with latest technology, and all the geoeconomic troubles imply a windfall for defense contractors and big tech who provide the new intelligence engine. Google is not the only beneficiary from tech-enabled warfare. We could see more employees protesting and preferring not to be part of the military supply chain at a time when people are more assertive on values and not just their compensation. Granted, possibly others will ask for more pay to soothe an aching conscience. And in Nigeria, will a new executive order spelling tougher penalties bring relief to the likes of MTN, Airtel Africa, and other telecom companies where costs associated with damaged cables soared, not to talk of the data and voice outages inflicted on some of the major corporate companies like the major banks. Many have said weak enforcement capacity has always been the bane of the country, not so much the adequacy of laws. Security is certainly key to attracting the right level of investment as the new government accelerates reform. Well, that's it from me on Global Business Insights. This is Bode Oshosami. Please share, kindly follow on Facebook and LinkedIn, subscribe on YouTube and X. Thank you very much for watching and following. Bye-bye.